Well, thanks so much for tuning into this edition of Trade Talks. And it's just very, very pertinent to get somebody who looks at cycles through charts very, very closely and tell us how does he feel about the current trading landscape in light of the fact that we are no longer at the lows that we ended up in the month of March, but are significantly above those. Whereas the global macro has seen one change, but not too many. The Gautam Shah of Goldilocks Premium Research joins in right now. He has an uncanny ability of not just looking at equities, but the correlation between other asset classes and equities as well. And that might be really important in a scenario like this. Gautam, great having you. Thanks for joining in.
Thank you, Neeraj. Thanks for having me.
The pleasure is ours. Gautam, how do you feel about this up move that we've seen recently in India? And what could the near term hold in store?
Well, Neeraj, to be honest, I'm at a loss of words because I think all that the markets have done in the last 2.5, 3 months is very unconventional. So you've had an environment wherein the Nifty fell from 18,900 all the way down to 16,800. And in this period, you really did not have any serious participation from the mid caps and small caps. So that's something which is very unconventional because in the past, whenever you had a correction of 10, 12, 15%, it's always been led by the smaller companies, which has really not been the case, and they have held out quite well. Number two, this entire fall has happened on a very low VIX. Rarely have I seen in the last couple of decades that you have a more than a 10% fall on the Nifty, and then you have the VIX at levels of 12, 13, 14, and 15. In fact, today it trades at about 12. So that's again something which is very, very surprising. And thirdly, in this entire 4-month period, you've had the Nifty underperform the rest of the world. Despite the recovery of the last 7 days, India is still one of the underperforming markets compared to any other market in the world. Just to put things in context, the German market, the French market actually hit lifetime highs a couple of days back. So that's the kind of strength that many world markets have seen in the recent past, and obviously Asian markets have also done well. So I think it's been a crazy ride in the last 4-5 weeks. The quick dip of about 1,000 points, testing that long-term support of 16,800, which was obviously a very, very important support. But what surprised me was the pace of the recovery. Now, is it on account of short covering? Is it something structural? I still don't have the answer. And I don't want to believe that this is a structural recovery and then all will be well forever. Because I think while we've come to the doors of this very important resistance of 17,800, 900, getting past the same in a hurry is going to be difficult. And I don't see anything on the charts and what my analyst tells me on the fundamental macros to say that, we'll start doing very well from here and go on to make new lifetime highs. So something like that is not going to happen. And as I mentioned at the starting of the year, this year is a year of consolidation. So if we can just continue to spend time on an index level between 16 and 19, I think we've done well for ourselves. So I think you will see patches of strength, you'll see patches of weakness, but the markets are not going to move big in either direction. And that's how we are dealing with the current behavior. But in terms of levels, 17,800, 18,100, extremely, extremely critical. Till we don't get past that number, I think the bears can still be in the hunt. So one should not just throw in the towel and say, go out and buy anything and everything. So we are staying stock specific, we are staying sector specific, we are staying theme specific. I think that's the best way to play the next 3 to 6 months, just ignoring the Nifty and Bank Nifty from our minds.
Yeah, I was on mute so that the noise isn't high. Okay. The thing is, Gautam, that this seems to be a rally of disbelief. Most people have not quite believed that there can be an up move and it's happened. Now, my question is, you made a very important point that even if the indices stay sideways, there are multiple pockets which could do well or do badly, depending on how the turn of earnings or the turn of macros behaves out there, right? So where do you see inherent strength independent of what could happen to the indices? Of course, if we have a 1,000-point correction on the Nifty, then mostly nothing will be spared, which is a given. But with that at the back of the mind, where do you see inherent strength?
Well, there are a lot of pockets which have shown inherent strength in the recent past. In fact, we have picked up sectors which did not do so badly in those last 4 months when the Nifty fell 11%. I think that's been our focus area. So if you look at what capital goods has done, I think whenever we've interacted in the last 1 year, what ITC was for me a year back, L&T became 6-8 months back. So I think L&T is clearly the poster boy for me, and it will continue to be this way going forward. I love the chart, love the fundamentals, and love the fact that it's one of the best proxies to play the India story. So I think L&T, I think, has been in our portfolio for a very long time. We like it, the entire capital goods basket. And to add to that, I think the PSU theme, I know I keep talking about it, and we've interacted a number of times. The CPSE index was at a lifetime high a couple of days back, when the Nifty is still far, far away from its own numbers. So that's again something which tells you that there are immense opportunities in a Coal India, in a NTPC, in a power grid. So the PSU basket looks great for a 15-20% up move from here. Pharma has made a phenomenal comeback. We've been watching it very closely, and we actually recommended multiple trades in the pharma space in the last three or 4 weeks for our clients. So right from Alchem Labs to Dr. Reddy's to DV's Lab a couple of days back, and some of the other smaller names as well. I think pharma has finally turned the corner for good. There have been 5 or 6 attempts to rebound, all failed in the last 6 to 8 months, but this rebound has looked structural. So I think there is a lot of catch up to do in the pharma space. And selectively auto. I mean, we covered Bajaj Auto just a week back because we felt that in the entire difficult space, Bajaj Auto did nothing. It was just totally sideways. And now, there's something very special happening on the charts. So that's again a pocket that we are liking. But the other pockets where we are staying away is basically metals, high beta metals, banks, Reliance Industries. So those are the pockets that we are staying away and committing in these 3 or 4 other names.
Pertinent. Let me try and probe some of these things individually. Now, like for example, I can relate to the fact that India didn't do well while the world markets were doing so well, simply because India had done so well in 2022 that this relative valuation had to correct. Now, the same argument, Gautam, I'm extending to say pharma. Yesterday was a different case in point, but we've seen the last 15 days, the screen tell us that there is selective buying happening in some of the pharma names. I mean, yesterday was the API companies, but before that, Aurobindo moved, some others moved, etc. Now, we, of course, waiting for the results and the commentary from the companies to come out and tell us whether the US generic companies will actually have a great quarter or no. But I would love to understand what within healthcare stands out as a chart for you, because I'll tell you why. Sorry, I'm extending this question, but I'll tell you why. Because fundamentally, a lot of people who track healthcare mention that they are not interested in the Reddy's and the Sun Pharmas and the Aurobindos of the world. They are probably interested in the Indian generics. They're interested in the hospital stocks, and they're interested maybe at much lower levels on the diagnostic companies. So people have a very different view of healthcare now and a very nuanced view. Where are you on this?
I would be a slight contrarian in context of the consensus view that you actually put out, because I think diagnostic was a big theme in 2020 and 2021. The Dr. Path Labs and the Metropolises of the world, they all became multi-baggers. And thereafter, the same stocks lost 60, 65, 70%. So it's quite baffling that fundamentally something can do so well in a year and then just lose everything. And that's why I think technical analysis plays a very important role, because you have to play these cycles, to actually eke out returns. Diagnostic, I think, is still recovering. Everybody's talking about some of these Metropolis. People have started talking about Laurus Lab, a well destroyer. Unfortunately, I have to tag it that way for the last 1 year. They're all recovering, but I'm not chasing these names. I'm chasing those stocks which actually stood out when pharma went through a massive bear market. So we love Dr. Reddy's. We love Sun Pharma. We love Alchem Labs. I think they did absolutely nothing in difficult times. And I think they are going to be the star performers. DV's Lab, I think, was a little overowned on the way up, and then was completely shrugged away on the way down. Everybody gave up on DV's Lab. But it got to long-term supports, and what a wonderful opportunity you had based on risk reward. So we love DV's Lab. If you have to play contrarian, don't play in leg 2 and leg 3. Play in leg 1. Play with the big boy. So I think DV's, the names which I mentioned, I like them. And just to top that list, Apollo Hospitals. I think that's a structural story for a decade. Even in the diagnostic fall that happened, Apollo is probably one stock which actually, held out, if you talk about hospital business and diagnostic put together. So that's the only name probably which we like in diagnostic, and ignore everything else.
Got it. Okay, thanks for that. The other question, Gautam, is on autos that you mentioned. Now, the fundamental view is split right down the middle. I heard you say that you like autos currently. do you like them from are you time horizoning it that it could be strong for a particular period of time and then cool off, or are you much more constructive? What are charts telling you?
Well, the kind of market that we are in, you need to have, you need to carry just about everything. Because what I say today, could be completely different 6 months down the line, given the dynamism that the world brings to the table. I think that's the kind of world that we live in. To be very honest, till a few weeks back in the second week of March, we were not very positive with auto. In fact, the charts had deteriorated quite a bit. We were quite worried. And we were and are still of the view that the Nifty at some point of time can still break 16,800. So if that possibility comes up, what happens to auto? They will obviously, move in sync. So we are selectively positive. I think we like the way Bajaj Auto has behaved. So I feel it's a structural story for the rest of the year. Go out there and buy that stock at CMP or maybe at all dip. We have officially recommended it at Goldilocks as well. We like the way Tata Motors is shaping up. I think it went through this big consolidation for almost 15 months. People have given up on it. Let's not forget, it is probably the best proxy to play the EV story, which I still feel is at the nascent stage. And Tata Motors, I think, is a good name in that basket. So Tata Motors we like, and Maruti, I think, is again a stock, which has held out very well in the last 2 or 3 months and should stand out. All the other names, Eicher Motors, Ashok Leyland, Hero Moto, not very sure. M&M also, I don't think that this reward justifies. So you have to be very picky in today's market. And just to extend this argument, in the banking space, we have all seen what HDFC Bank has done vis-a-vis ICICI, SBI, or some of the other names in the last 2 months. So, this is a market where you need to be very, very stock specific. And some of these laggards of the last 15 months are now making a comeback. So I do see the HDFC twins as one of the star performers for the rest of the year.
Oh, okay. And I can clearly see you sticking to the big boys. The thing that you mentioned of a pharma, you kind of extending it to the others as well, which is interesting. The other thing is real estate. Now, you were constructive at some point of time, then you turned a bit cautious about it. Purists on the fundamental side, and rightly so, would argue that the fundamental performance was always strong. The sentiment got soured because of interest rates. Now that we are looking at a pause in rates, can sentiment turn the stocks back to what they fundamentally could be deserving, which is, the last 12 months, the sales have been spectacular. Have the charts turned for you on real estate post the RBI move last week?
See, the RBI pause is definitely a game changer for real estate. No doubt about that. The screen is showing that, and the charts have been showing that as well. A couple of years back when I was asked for real estate, I said that the sector is broken out from a 10-year range. So when you have such a massive breakout, you are going to have ramifications for few years at least. Okay. Now, it ran up really well. It gave you multi-bagger returns for a couple of years. It got a little overextended. People started putting all kinds of numbers on the Excel sheets. That's not how markets work, at least in the last 1 year. And I think because the Nifty fell so big, real estate is high beta, it had to fall. But which were the stocks which didn't fall when real estate fell? That's DLF and Oberoi Realty. And those are the two names which have really been part of our long-term picks, for a very long time. And we in fact, recently covered DLF once again as well. So real estate, it seems, has turned the corner, just like pharma. I think the uptrend has resumed. And irrespective of the market trend, I think it is a sector that will do well. But again, you want to be very choosy there. I still don't want to go towards the route of Lodha or Godrej Properties. I'm still comfortable with the DLF and Oberoi. I think they could give out stellar returns over the next 6 to 12 months. And obviously, as you rightly said, the sales numbers have been fabulous and the charts are now in sync.
Interesting. Gautam, what is doing well fundamentally? I would love to understand from you. You've spoken about a lot of contra themes. Now I want to talk about themes which have done well in the last 12 months, but the numbers seem good and look set for more. Okay. So say hotel stocks, they're case in point, and the managements have sounded confident, if not for Q4, then for the rest of the year for sure. So that's a pocket that companies are saying that we'll do reasonably well. So no reason to doubt there. What is your view there?
I think I like to stay with the big boys. I think I'm extending that argument and maintaining that theme all along. And I think the performance of Indian hotels versus an EIH or a Lemon Tree, I think, is a clear giveaway as to how market is dealing with the top stocks. And unfortunately, we still live in a world wherein you have to look at the COVID numbers every day. Till a few days back, it was 6,000 cases a day. And honestly, after the experience of the last couple of years, there is always that thought in mind that if these numbers go out of hand, can it actually impact some of these unlocked stocks? So maybe that's also a minor reason why they might not see a runaway move so easily. But having said that, for me, Indian hotels is a structural story. I think I am playing it as a 10-year theme. We covered it as our Diwali pick last year. We still like it. It's behaved very well in the recent times. So Indian hotels probably one of the best names. And I'll follow that up with Mahindra Holidays, which I think is also a proxy to hotels. And that's also a good stock. It's almost close to 52-week highs and is likely to do well. The other names, I'm not too sure. In difficult times, they might not stand. So I want to stay with the big names.
Okay. And the other argument is in a pocket that you like, which is capital goods. Now you mentioned L&T, but when I hear the commentary from some of the MNC cap good names, their commentary on their earnings growth potential is very, very strong. So the Siemens, the ABBs of the world, but they're expensive. So, but on the charts, do you like these names or are they less attractive compared to, say, maybe a Larsen?
They're actually all very attractive. When the Nifty started correcting from 18,900 levels, we were a little concerned that capital goods had run up a lot last year and therefore there was room for correction. But in technical analysis, corrections are of two types. One is price-wise and one is time-wise. So what capital goods went through in the last 4 months is a beautiful time correction, which was totally sideways for most of these stocks. And now as the market is stabilizing, capital goods is perking up once again. So we like the big four, which is L&T, Siemens, Cummins India, and ABB. And I think all four of these stocks should do well over the next 6 to 12 months. Stay invested, do not get out cheaply. I think when you can make a 300, buy, get out at an 80. I think that's the recommendation there. And use all dips to buy into, because these market volatilities will give you opportunities to get them at lower prices. So use them.
Okay. Final three questions. IT, crude, gold. Start with IT. Are the charts fuzzy or do they indicate something?
Charts are good, Neeraj. I don't see any concern there. I think it was a little, I think it's, people are a little more pessimistic. Mid-cap IT has done quite well. I think Persistent was our Diwali pick last year. We also like Sign. We are watching LTI Mindtree very closely. So mid-cap IT as a basket has done quite well. But the SVB issue in the US, I think, led to some sort of a sentimental collateral damage for IT stocks here in India. I think that could be the impact. But now with most of these IT stocks at medium-term, long-term supports, I think the risk reward is excellent for a serious long-term investor to buy quality at these prices. So I think go ahead and buy both IT and pharma. I think you'll stand out quite well.
Okay. What about crude? It started a bit of an up move after the geopolitical moves that have happened. And subsequently tied to that, do any of the OMC names look skittish as a result of that? Or do ONGC and All India look constructive as a result of that?
I think crude bottomed out at the recent low of about 68, 69 on NYMEX. I think it was a major low. A large down cycle seems to have got completed. And this looks like a new uptrend that is going to continue. So the charts are positive, and I do see NYMEX moving to a level of 90, 95, maybe even back to 3 figures once again. Wow. So given that data, once again, I don't think it's going to be good news for Indian markets in a way, because we've been working with this interrelationship for a very, very long time. But if you talk about crude behavior with OMC, well, OMCs we've never liked any which way. So I've always stayed away from a BPHP. ONGC, Oil India, I think there are other stories at play as well. So I think because the entire PSE theme is doing well, ONGC and Oil India will do well, not necessarily get impacted because of the crude movements.
Okay. So not because of crude, but because of the PSE thing, but you believe that there could be upsides there. Okay. The final question, there's so many social media posts about how the Indian housewife is the smartest investor. And I'm so happy really, because Indians per se have invested in gold and the dollar returns as well as the rupee returns have been good. My question to you is, with these highs that we have recently seen, what is in store next for gold, Gautam?
It's the tip of the iceberg. I think there is a lot of upside in both gold and silver. I've been a big bull for almost 15 months. You had a big rally, then a year of consolidation. Anything happens to, in the world, and we live in a world where, something comes up every 2 months, gold and silver are beneficiaries. So I think I love the chart setup. I think the massive consolidation is over. 2070 was our working target, international prices on gold. I think we'll get there very soon. Once that is cleared, I wouldn't be surprised if over the next 12 to 18 months, you see gold moving towards 2400. So a 15% move on gold is entirely possible, which I don't see for the equity market benchmark indices. So, you need to be topped up on gold, and silver could potentially see a much larger move. Today, it's standing at about $25 international prices. I see a move towards 29 at least, and maybe even a level of 32.5 at some point of time. So potentially 30-35% upside on silver. So stay invested. I think that's more important than doing anything else, and use all dips to top up.
Got it. Well, I'll spare the fertilizers and the others because those moves can be frenzied. Gautam, this was great talking to you. Thank you for giving us all your expertise. Lovely talking to you as always.
Thanks, dear. Thank you.
And viewers, thanks for tuning into this conversation.